All right, so we had another really busy earnings week. Several big companies, several of my top companies released earnings, so I wanted to get into that. Let's get right into it here. Apple being the biggest one that released this week. They easily beat earnings, like easily. I don't even think it was close. But the stock was actually down about 2% on the week. And again, we're seeing this with a lot of stocks. Not only that, the market as a whole. We've seen a very good earnings, a solid earnings, maybe not very good, but pretty good earnings season. And yet the market is actually, I believe it's down a tiny bit now. But and it's kind of for other reasons. But I think the main reason we're seeing this is we're kind of at an area of resistance right now. And I think that we're going to see a little bit of a pullback probably within the next month or two. And then depending on what happens, if there's something catastrophic, we probably have a significant pullback. If not, we probably head towards all-time highs towards the end of the year. At least that's my reading on the market right now. So Apple, I think it's definitely a little bit overpriced right now. Let's look at the valuation. Yeah, price to free cash flow 31, 5-year average 22. I was buying this when it was around like 150. I stopped buying it when it went above about 175, 180 or so. I would wait until it goes below probably 170 roughly before I'd start picking it up again. Although I think of the big, like the mega cap companies, Apple probably is my favorite. But again, just my opinion. The next one here is Amazon, and I must admit I made a mistake last week. I talked about Amazon when they actually released this week. I don't remember exactly what happened, but what probably happened is whenever I get a little bit of downtime during the day at work, I will research, I will take notes and stuff. When I was reading up on Google, it would have been, because I know Google released last week. I remember reading a little bit about it. They probably mentioned Amazon somewhere in the article that I was, and for whatever reason I wrote down Amazon. So again, I must admit I made a mistake there. Google was the one I was trying to talk about. They did very good, solid. They did have one problem that they ran into. Google, probably neutral, I guess would be a better way of putting it as far as their earnings go. But as far as Amazon goes, Amazon was actually very good. They easily beat earnings. They destroyed earnings. Revenue, I believe, was pretty close, but Amazon, again, another very solid company. A lot of their metrics don't look as good as the other one, but that's just because that's kind of the way Amazon is. That's kind of how they do their accounting and stuff. The PE is not a good metric to go off. The price of sales is actually a little bit below. I still would like to pick it up cheaper. I mean, if it went below like 120, that's when I probably start to dollar cost average a little bit again. But again, that's just my opinion there. But I mean, honestly, of the big tech of the big mega cap companies, the only ones that I wouldn't be touching right now is Tesla would be the most likely not to touch. Then it would be Nvidia, because their valuation is just crazy. They are a very good company. And then it would be Microsoft. Again, similar story, just not to the same degree. All of the other ones, I mean, Google I think is solid, although I want to get them cheaper. You name it, right? Apple, Amazon, I already went over them. As far as the next ones go, ANET or Arista Networks, this is a company that I've been wanting to get into for quite a while. They're just too expensive, right? Price to free cash flow of 89. As far as their earnings go, they beat earnings and revenue. I think they beat it by quite a bit, actually. They were up pretty sharply on the week because of that, actually significantly on the week. Let's check and see here. About 16%, which is crazy, right? So again, they were already expensive, and now they're just crazy expensive. So I don't know if I'll ever get into this company, but again, if they ever reach a good valuation, I definitely would be wanting to jump in, because I think that this is a very good company in my opinion. The next one is ON Semiconductor. This is one of the better semiconductor companies in my opinion. Don't have a position, but like I said, I think it is one of the better ones. They beat earnings and revenue. And they're not crazy expensive, I don't believe, unless something's changed significantly. Yeah, price to free cash flow is almost right on their 5-year average. The PE is actually a little bit below. So again, this is a company that's definitely more reasonably priced. It is still a very good company in my opinion. The next one is Caterpillar. So I was on holidays about a month ago or so, and there was a ton of construction on the way to the place that I was going. It's like a 10-hour drive. And virtually every construction area had Caterpillar equipment, so I kind of put two and two together there, and I'm like, hey, I should probably check into Caterpillar stock, and sure enough, I did. They look pretty good to me, and I started dollar cost averaging. They've been up a lot since then. I mean, if we go back, I mean, they're up a lot on the week because they reported very good earnings. They're up about 7.5%, which is pretty crazy for a company in this area. If we look at their valuation, they're actually still a little bit below their 5-year average. So I don't think it's too expensive where it's at right now. They have very good management. They're fair. They're moderately profitable. Very good growth. Solid financial health. Their dividend is also very intriguing. That's another reason why I'm happy with this company. It's only 1.85% right now, but again, you got a 38% payout ratio. They're growing at 9% a year, right? That's what I want to see. These companies that are consistently growing that dividend over time, that's exactly what I want to see. The next one is Devon Energy. This is a company I have been a fan of, not quite as much because lately, because I think there is better companies now that I've found some better ones, but I still think it's a solid company. And as far as earnings go, they did beat earnings, but they missed revenue. And again, this is going to follow the price of oil. I think we're going to see higher oil prices at some point. It's just a matter of when. And when you see pullbacks in some of these oil companies, might not be a bad idea to pick a little bit up, especially if you're underweight. The next one is MicroStrategy. I follow this company mainly because of the Bitcoin that they have, but they actually did good. They beat their earnings and revenue, although the stock was down, right? But again, they're going to follow Bitcoin just because they own so much. The next one is Starbucks. Again, don't have a position, but I do like to follow them. They are a little bit more expensive than I would like to pay for them, especially the kind of company they are. If we look at their valuation here, price of free cash flow of 42, that's just way too expensive for a company like this. I'd want to get them in the mid-20s. That's the most that I would pay. So again, it would have to get a lot cheaper before I would look to pick it up. They do have record revenue, but the sales are down. So that's a little bit concerning to me. The next one is CIVI. This is one of the better oil and gas companies in my opinion. They did pretty good on earnings. They beat their earnings and revenue, although again they are down year over year, but that's because of the price of oil and gas. But honestly, this is one of the best oil and gas companies that I've came across recently. Again, crazy good earnings yield. The dividend is solid. Basically everything you're looking for in my opinion. They're actually growing it over the last few years, which is pretty nice to see. So again, that's one of my favorite oil and gas companies right here, CIVI. The next one is Occidental Petroleum. Speaking of oil and gas companies, revenue and earnings were both down. This is the Warren Buffett stock. Again, I still think it's a solid company. I do have a small position in this company, but honestly, I think it might be a little overhyped simply because Buffett's buying it. But again, just my opinion. Realty Income, again, don't have a position, but this is probably the most popular REIT on the market. It has gotten hit pretty hard this year. I mean, it is down 6%, which again, for a year that the markets are up very, very nicely, it's kind of surprising, right? They beat revenue and earnings, which is kind of surprising considering the stock was down. But again, they've just been hit pretty hard recently. Let's check out the valuation. I'm kind of curious to see where it would be at. Price to FFO is actually 31% below their 5-year average. So honestly, this company probably is cheap where it's at right now, right? It probably is. Its dividend is over 5%. So if you do like Realty Income, now is the time to buy. I'm not a fan because I think that it's an okay company. I just think that there's better options. As far as the next one goes, Coinbase, again, I follow it mainly because of it's in the crypto space. It beat earnings and revenue. So again, that's good news for them going forward at least. The next one is Extra Space Storage. This is probably one of my top favorite REITs. It's actually basically right at its 52-week low. So again, if you're looking to pick it up, now is not a bad time, right? The revenue was up a little bit. Earnings were basically flat. If we look at it, though, again, the price to FFO is actually above the 5-year average. So I don't think that it's necessarily super cheap. But again, this is a company that's done very, very well. I mean, the profitability is very, very good. The management's very good. The growth is solid. Like, in my opinion, there's not much not to like about this company, which is why I like it right now. As far as the next ones go, Microchip Technology, another company that I really do like. Earnings, sorry, I can't read my own writing. They beat revenue and earnings, essentially. So again, this, like I said, this is probably my favorite microchip or semiconductor company right now. And it's not because I think it's necessarily going to be a easy 10 bagger necessarily. It's just that it's growing nicely. It's always easily outperformed the market. I mean, if you go back 20 years, this is one of the top performing companies in the S&P 500, which is why I like it, right? And they're growing their dividend nicely. The stock was actually down a little bit on the week, but I think it was bordering on expensive where it was at. Let's see what its valuation is right now. It is still cheap. It is still cheap in my opinion, right? Price of free cash flow of 15.6, right? In my opinion, that's still cheap, especially for a company that has easily outperformed the S&P over the last decade or two, and it's growing its dividend very nice, right? So again, just my opinion there, but do your own due diligence. The next one is going to be Monster. This is a company that I've wanted to get into for quite a while, but again, it's always been too expensive. It missed revenue. Earnings per share were actually right on the projection. It was basically flat on the week, down slightly. But again, if we go into its valuation here, it's still crazy expensive. Price of free cash flow of 54, 5-year average 43. I'd want to get it below 40, maybe even mid 30s before I would look at picking it up. So it would have to come down quite a bit before I would be interested. And then the last one, again, this is another one of my favorite companies, Qualys. I'm not sure if that's how you pronounce it, but QLYS. They easily beat earnings and revenue, especially earnings. I really, really like this company. This is one of my top 5 to 10 favorite companies. Again, it is a lot of room to grow. It's growing very nicely. Doesn't pay a dividend, which is the one thing that I kind of wish it did, but I still think that it's going to do very, very nice. It's crazy profitable. The valuation is still solid. It's not crazy expensive. Stock-based compensation is definitely a little bit of a red flag there, but overall, I think it's a very solid company. So again, that is this week probably was the busiest earnings week of the year. We're going to slow down over the next. Within a couple of weeks, we'll be slowing down because most companies have released by now, if not within the next couple of weeks. So it's going to be interesting to see what the market does over the last half of the year. Like I said, it's guaranteed we're going to get a pullback. It's just a matter of how deep, right? Is it 5%, 10%? How deep? My guess is it's probably in there somewhere. Maybe we pull back to the 100-day moving average, 50-day moving average. Probably somewhere in there, right? That's just my opinion. Do your own research. If you like the video, hit that like, subscribe, comment, all that good stuff, and stay tuned for more.